Please stick around until the end of the video to learn about the DTI calculator that I created online for you to use for free.
Today, we're talking about DTI, or debt to income. Debt to income is a calculation expressed as a percentage where your total debts are divided by your total income. These are monthly amounts. Typically, for most loan programs, the maximum DTI is around 45%. There are many components of debt to income, but we're going to take a step back to the 5 C's of lending. And I'll show you where debt to income fits in. Number 1, there's character, which I told you is really credit, capacity, collateral, conditions, and capital. In terms of the debt to income calculation, your debt is a reflection of all the payments that report on your credit, including things like car loans, credit card minimum payments, and sometimes this is not on your credit, but it would also be included child support or alimony payments. Some states report child support to the credit reporting agency. So if it's on your credit report, then that calculation will be based on the amount that is owed each month as it appears on your credit report. The other debt to be aware of is any undisclosed debt. This is pretty rare, but every now and then someone may have a debt that is not on their credit, like a land loan or a foreign property mortgage or payment that doesn't appear on their United States credit report. Those are pretty edge cases, but just be aware that if you do have a land contract or you make a monthly payment to someone, that will need to be disclosed to your lender. In terms of income, talked about debt drawn from payments on your credit. Income is part of capacity reflected on your pay stubs, W-2s, and tax returns. Income ties into the concept of ability to repay. The lender has to document that you have the ability to repay the loan and that you have the capacity to repay your loan. And that is a reflection of your income, your documented income. So the lender is documenting that you have enough income to repay the loan. And that is where that 45% debt to income comes from. It's a predetermined percentage. It is a guideline to say, we want to make sure that your debt divided by income is no more than 45%. I'm using 45% as a general percentage. Sometimes that number is more, sometimes it's less. It can range from about 43% to 49%. 45 is the most common. So if you're doing some estimates on your own debt to income, plug in 45% and you should be safe. As I mentioned, debt to income is your debt divided by your income. So your income is determined from pay stubs, W-2s, or when the lender runs your credit, when the lender gets your loan application, they are going to run that application through an automated underwriting service. And in some cases, they may get an instant verification of income, which means that you might not have to provide income documentation because they were able to validate the income that you listed on the application through their automated underwriting. So it's nothing that you have to do at all behind the scenes, and it's tied to the payroll provider. So when they enter your name and your social and your employer name, they are able to pull back your income information. This happens about 30% of the time. So there is a chance that you might not ever have to provide your pay stubs or your W-2s because they automatically got this data back from the automated underwriting service. In the case that you're self-employed, you need to provide 2 years of taxes. Sometimes you will fill out a form with the lender and they will get 2 years of your tax transcripts on your behalf. Now, 1099 income will always be considered self-employed. And in this day and age, it's very common that people could have several 1099 sources of income. They could work at Instacart or Uber or Lyft or Amazon doing deliveries. All of these employers would be giving you a 1099 and you would be filing most likely a Schedule C for your taxes. Your qualified income is based on your taxable income. So when you're making deductions and writing things off, that is reducing your taxable income. I broke down a little scenario here. In this case, let's use an example of someone that made $90,000 in 1099 income. Let's say they wrote off $50,000 in deductions and expenses, and now $40,000 is their taxable income. Well, that same $40,000 is also their qualified income. So this has a significant impact on the loan that you're able to qualify for. because if you're only reporting $40,000 in taxable income, that means that your maximum DTI based on that 45%, all you got to do is multiply 45% times that monthly income that we just figured out, which was $3,333. If your net taxable income was 40 grand, your maximum debt payments, including your mortgage and anything on your credit, is going to be $1,500. That's pretty restrictive. So just be mindful that when you are writing things off, if you're planning to buy a house, those write-offs are going to have an effect on your total taxable income, but also that's going to translate into your net qualified income for calculating debt to income. Your debt to income is your debt divided by your income. And just to help you understand the concept, let's say your monthly debt from your credit is $600. That includes your car payments, your minimum monthly payments on your credit cards, and then your new mortgage payment, let's say it's $3,100, or a total of $3,700. And let's say your income is $10,000 a month salary. You make 120 grand a year, and you're a salaried employee. So your monthly income is $10,000. So we're going to divide $3,700 divided by $10,000. So your DTI in this case would be 37%. Great, because that's less than the maximum of 45% DTI. So in this scenario, this would be within the limits of qualification. Using this round figure of $10,000 a month, that means you could have monthly debts inclusive of your new mortgage payment of $4,500, because 45% times 10,000 is 4,500. So you can always figure out what your maximum allowable debt payment is by multiplying that 45% by whatever your monthly income is. And then you'll get a rough idea of what amount of debt you can qualify for when you're looking for a mortgage. I came up with this $3,700 mortgage payment by using the average U.S. median home price, which is about $400,000 at 6%. And here we have principal and interest, mortgage insurance, property tax, and your house insurance, which is really called homeowner's insurance. I'm calling it house insurance just to explain that your house insurance is the insurance that covers your house. Mortgage insurance is insurance that covers the lender in the event that you default. So the mortgage insurance doesn't really add a lot of value to you. It's your house insurance premium that covers an insurance policy that covers your house in the event that there's damage or fire, etc. In this case, if we have a principal and interest of $2,400, mortgage insurance of $200, property tax of $300, house insurance $200, your total PITI is $3,100 a month. I'm using a rough figure of 1% of the value of the home as the potential property tax amount. This is not standard across the United States. Every state has different property tax rates and rules. Some states don't have property tax. So if you're in one of those lucky states where there is not property tax, great, you can cross that line item out. So to come up with your DTI, add up all your debts plus your proposed mortgage payment. You're going to divide it by your monthly income, and that's going to give you your DTI. Taking a step back, what's your PITI payment? That's your principal, interest, taxes, and insurance. You'll hear this jargon in the loan application process. It's thrown out quite commonly, so just be prepared. PITI is just your proposed mortgage payment. That's the payment that you're going to make every month once you get a home and a mortgage loan to go with it. So the big takeaways are that DTI is a reflection of the maximum debt to income ratio that a lender will allow you to have to qualify you for a mortgage. DTI is a major driver of loan approvals. Typically, the max is around 45%, and it's your total monthly debts divided by your total monthly income. The lower, the better. And this ties back into your ability to repay, which is a key concept in understanding mortgage lending. The lender is required to document that you have the ability to repay the loan, so they are required to thoroughly examine your credit and income as a part of their loan process. Please like and subscribe this video so that you're alerted when our next video in this series goes live in the next few days. I have an exciting DTI calculator. Plug in a few key pieces of information, and we will calculate your DTI for you. The link is in the description. You'll find it at mortgagetoolbox.ai. That's mortgagetoolbox.ai. Just look for the link to the DTI calculator. Thanks for watching, and see you in the next video.